may end up kind of overlapping. But yeah, let's go for it. So just as an introduction, so yeah, we are the first, and I'm the CEO of Bangladesh Angels. My name is Nirjhor. I'm a Bangladeshi Texan, so I was born in Bangladesh, but grew up in Texas, and then I've been back in Bangladesh full time doing social enterprise, and then recently, I guess, more venture investing over the last couple of years. Yeah, so we are the first and largest angel investment network in the country. So far, since last summer, we've invested in 6 companies, including 2 in IC. So Jantrik is one, which I'll talk about, and another is called Rentsoft Solutions, which is in the healthcare space. So far, it's been about $500,000 invested, and then there's been co-investment as well. This is kind of interesting, because of COVID, we've become very digital. Like, I'm in Texas. Many of our members are all over the world, so we've created a membership, an investor base in 4 continents, which is exciting, a great foundation for the future. And then we also have impact investors who are kind of part of us as well, right? So one company is called Avishkar. So they're based in Mumbai, but they manage impact assets around the world, including in Southeast Asia, South Asia, as well as Africa. So they're one of our shareholders and sister concerns. Another company, our organization is called the Dutch Global Good Fund. So they're an arm of the Ministry of Finance of the Netherlands. So they've also been kind of our main sponsor and backer. So there's also an impact element as well, although our focus is on technology ventures, with the commercial focus, with maybe some impact. And by the way, it's a small group, so feel free to interrupt me anytime, and happy to answer any questions. But yeah, I guess I start all of these presentations with a confession. So because a lot of entrepreneurs, whenever I sit down for coffee with them, they're kind of intended to ask, like, what do you think about my idea? And then I hate answering that directly. And because hard way when I started this role about a couple years ago. My job isn't necessarily to prove how smart I am, because I'm not, right? I'm learning just like all of you. And I think to really succeed, either as an investor, as a founder, as well as an ecosystem actor, all of you know this, you need a ton of optimism, and you also need a lot of humility, right? A lot of companies that I've been excited about ended up not going anywhere. A lot of companies that I was kind of lukewarm about ended up, raising money and going somewhere. So I think those are quite important, is to have that kind of optimism and humility. And what I've also learned through some of our more experienced members that I've kind of been able to learn alongside is that the best investors are also pitching, right, within any kind of meeting. They're pitching about, and they're specifically thinking, as they collect data from the entrepreneur, they're thinking about 2 things, right? How can this idea or company succeed? How can it do so quickly? And then they're pitching those ideas kind of back to them. And obviously, if there's a rapport, you have the beginnings of a potential partnership. The other way I like to kind of think about angel investors, they're almost like Pokemon, right? There was a great podcast I'll share with you after. I don't know if you remember watching Pokemon growing up, but Ash was going through his journey as a Pokemon trainer. He has these different kinds of Pokeballs, and he has this kind of portfolio, so to speak, of Pokemon. And some of them level up over time, right? They move into the next stage, and as Ash himself grows, and he uses them for different kind of battles. But then some of them just he only has so much room in his pocket. He can only carry so much of them with him, and so some of them have to kind of go along on the wayside. And unfortunately, the journey has to part at some point. And I think that's true for a lot of angel investors, right? You're looking for, and if a startup is really skill sets, you're looking for a few key skill sets at certain points in your journey, right? And that's kind of that's the starting point. Now, how do you go out and meet angel investors? I think it's never been easier, right? There's angel networks all around the world. The IC is a great one. I think the entire roster of experts and judges, many of them are angel investors. I think that's a really great connection that you have. AngelList is amazing as well. I've been able to meet a lot of people through AngelList recently who are interested in the Bangladesh market, and we're having a lot of discussions there. I think definitely, look for warm introductions. And even if somebody says no, it really means no at this particular time. And what I really appreciate about founders who are persistent isn't necessarily that they're always pinging me, but once a month I'll get a public newsletter about where they are. And it's a good way for me to track them, and over time, maybe if it makes sense, I can kind of bring them into the fold of Bangladesh Angels and distribute them to our members. So those are some of the sort of best practices I've seen in terms of communication pre kind of the screening and things like that. I'm going to structure this kind of presentation in 4 parts: so screening, pitching, due diligence, and structuring, and some post-investment monitoring as well. So I guess the first thing I would say, and I think most of this is pretty obvious to most of you, is that startups are all about growth, right? There's a difference between the vast majority of businesses, which are small businesses and often service companies, and what a startup is. And I think I'm reminded of what Jason Calacanis, who's a legendary angel investor, talks about, which is, it's taking any kind of venture capital, right? Whether it's early stages in terms of angels, or whether it's a proper institutional round, it's a very unnatural act because it's the equivalent of dousing yourself in jet fuel and then lighting yourself on fire, right? Most likely you'll get burned, but then if you do end up not getting burned, then you'll get very far. I mean, maybe that's a very difficult analogy to make, but I guess I face this a lot in Bangladesh. I'm very curious about your particular markets. A lot of companies aren't actually startups; they're actually small businesses with some kind of a digital front end. Right. And what that means is for them, the way they're structured, the way they're built, 30 to 40% year over year growth is quite attractive. And it often ends up being a lifetime business. And to ask for anything more, it's actually not possible for that kind of business. It's almost unnatural. But then startups are the opposite, right? They have to generate, 30 to 40% kind of growth month over month consistently. Obviously, there's a gestation period in the beginning as you're building your product, trying to find product market fit. But once that is being done, or once you're kind of achieving that, I mean, that's the growth rate that's expected at a minimum, because angel investors have opportunities. They have a lot of opportunity costs, right? They can put their money in a bank. They could get put money in bonds. They could put in the capital markets. They could put into real estate, right? They could put into their children's education, right? They could funnel it out. If it's a frontier market, they could funnel it out and build a nice life in Canada or US or what have you. So you have to think about the opportunity cost, and for them, they're specifically looking for, at the minimum, 3 to 5x returns in 3 to 5 years, if not more. That is kind of the floor, right? And for that to happen, you have to achieve that kind of growth. And obviously, software companies are great because of that. You're able to kind of obviously build the initial kind of product, get it out there, and the kind of incremental cost of each user is pretty marginal. But then obviously, if it's a physical company, it's much harder to kind of achieve that sort of scale, right, and traction. Another key idea is, startups are a hypothesis, right? And once again, it's related to those two questions. How can it succeed and how can it succeed quickly? And so I actually took this from Y Combinator. They've got a great program called Startup School, and it's really helped me kind of think about this. But yeah, what are the kind of 3 elements of a startup idea? First is the problem, right? The particular problem that you're trying to solve. The solution, your company, and then the insight, right, is the particular unfair advantage that you're also trying to build within the company, so that once again it can succeed quickly. Another way to think about it, this is also from the Y Combinator presentation, startups are all about changing behavior, right? People have certain existing behaviors that you're trying to kind of migrate them from through your own platform, through your own solution. So what elements are there in changing behaviors, right? So one is the motivation, the particular problem, once again. The ability is your company, and then the trigger is obviously how they learn about the company, right? How, the different conversion points that you build in, so then you're able to, and the more conversion points that are built, the more opportunities you have for them to kind of become your users. And hopefully, the next step would be then retention, right? Yeah, so I think this is an important one, and I think this is kind of where I start with these. 1 second, right? This is kind of where I start with a lot of these conversations, and what I'm listening for whenever I sit down with an entrepreneur is what is the problem that they're solving? And not all problems are created equal, or not all problems are as attractive than others, right? So the first one is it's popular, right? Do a lot of people have that problem, or a lot of businesses have this particular problem in a particular country or particular kind of region or geographic area? The second is growing, right? I mean, is this problem growing? Is the market growing as more and more people have this problem? Particularly if you think about emerging Asia, the long-term trends, right? Urbanization, increased wealth, and as people, and particularly COVID's another interesting case, right? As people's behavior change, as people's lifestyles change, as their eyeballs, shift. What are the specific problems that creates for people, right? Urgent, that's important, right? It needs to be solved quite quickly. When people have this problem, or a business has this problem, it needs to be solved quite quickly, and it's second. The fourth is expensive, but it's expensive to solve. It's not cheap. It's definitely kind of hurts their bottom line and their wallet. Mandatory. If somebody has this, they can't avoid it. Often it's kind of determined by laws as well. That's one kind of element of that problem. And frequent. It's something that happens over and over again. I'm not saying every problem has to have all of these elements, but the more is better. And I think oftentimes if a company is not really having fast growth, part of it could be that they're not solving the right problem with these elements. So I'll just give you an example. So yeah, popular could be millions of people. In Bangladesh, we have 160 million people, right? So ideally, a problem is faced by millions of people rather than a small segment of the population. Growing, at least double-digit growth every year, and I would say that's the least attractive element, right? I mean, in a growing economy, many problems are growing. So urgent, yeah. I mean, as soon as the people have to solve it. Expensive, hundreds or thousands of dollars over a month or year or years. I'll give you one example. When before Uber came to Bangladesh, I would spend at least $6 to $8 per day going across town from my house to my office using a tuk-tuk, and it would take me 3 or 4 hours in traffic, right, both ways combined. And when Uber Moto came around, I could do the same thing for $1 or $2 each way, and not only that, but I would cut my commute time in half. So I could imagine over the last 4 or 5 years that Uber has been in the country, I've saved literally thousands and thousands of dollars, obviously, explicitly through my wallet, but also implicitly by saving my time. And so there's a reason why I use that as opposed to I've not gone back to tuk-tuk since, right? Another is mandatory, right? And this is quite interesting for emerging Asia as well. Legal structures are changing quite rapidly. Policies are changing quite rapidly. One example is Kata Books from India. They raised $50 million, I think, over the summer through a Series B, and particularly because the Modi government has been really pushing digitization of SMEs, right? And so that kind of created the impetus for many SMEs to sign up on their platform. Once again, frequent, daily, weekly, monthly, quarterly. Solutions, don't start here. What I would say about that is you often see this with founders, at least in Bangladesh. I'm curious how it is in other markets. Is that maybe you lived abroad, or maybe you studied abroad, or you saw something abroad and you want to bring it here, right? Or you want to work on a problem, a specific, you want to work on something specific, learning or OCR or something, right? And so what happens is I think you lose sight of the particular problem. You lose sight of, I guess, the people you're trying to solve the problem for. And I think there's this implicit assumption that whatever the founders want is exactly what the rest of the society is asking for at this particular moment, right? And so I think that's often the challenge. So for me, solutions can change all the time. In fact, when angel investors invest, that's kind of understood that the solution and the particular business model around it will change, and quite frequently before you go to then a Series A and beyond into the growth stage. And so that's not really the issue. I think what I'm looking for more is, how much do you care about the problem? How well do you know about the problem? Could you offer me insights that makes me kind of think, okay, this is it's a different kind of point of view than I'm used to, at least as far as how I understand the market, right? Insight, it's an unfair advantage. It's related to growth, and you need at least one. So what's the unfair advantage? So founders is key, right? I mean, that's probably the number one, and 90% of the decision making at the angel stage is the quality of the founders. And in particular, I mean, if you were to quantify it, I mean, the question would be, is this person or group of people really in the top 1% of the country when it comes to solving that particular problem, right? It could be generally in the top 1% of the country. Maybe you studied abroad, you worked at a multinational company, that's great, but once again, that itself is not necessarily the qualifier, right? And certainly not the basis for a high valuation. What we're looking for is, have you worked on this specific problem somewhere, and you have a really good kind of point of view on that. Second, market, right? But that really isn't, that can't be the only advantage. Another is product, right? I mean, ideally, if, once again, going back to changing behaviors, migrating people from one kind of existing set of behaviors and conditions to whatever you're trying to do, I mean, it's got to be 5 to 10 times better. And it could be quantified, right? Once again, I will use my Uber analogy of saving thousands of dollars. It's literally 50%, whereas it used to take me 30 minutes to even find a tuk-tuk, it takes me 3 minutes for an Uber to come to my house. It's literally 10x better. And that's why I continue to use it. Acquisition is important as well, right? Oftentimes I get this a lot. A company's looking for $150,000, $250,000, and I ask them, well, how are you going to spend the money? Well, marketing, operations, and tech. All right. And so how are you going to do your marketing? Facebook, which is not an unfair assumption particularly in a country like Bangladesh. I don't know if you guys have heard, but we have one of the highest concentrations of, say, Facebook-based commerce. Facebook is kind of the main medium. A lot of people equate Facebook with the internet. I would imagine it's similar in some of these other countries as well, which is fine. I mean, you have to advertise through that, but then if the only thing you're doing is just kind of taking investors, and then putting into Facebook boosting. That's not a particularly attractive marketing strategy. Obviously the best kind of acquisition is word of mouth. It's $0. It's through it's minimizing customer churn. It's having customers who then become recommended to their friends, and obviously customers that keep coming back, right? And then lastly is monopoly powers. Peter Thiel talks about this a lot, right? Competition is for losers. Startups are trying to create, I guess, new industries, and they're trying to create moats within those industries. So that's how you win the market. So what are elements of that? So economies of scale is a big one, right? For any kind of software company, as you grow and as you get bigger, but your fixed costs stay the same, so you're able to, distribute a lot more of you're able to distribute the same or similar levels of fixed expenses over a much larger user base, and so your kind of margins increase over time. But that's related to unit economics. I always found that a lot of startup founders, at least at my stage and maybe in Bangladesh, don't think enough about their unit economics. I'm not saying that it has to be perfect right away or positive in the beginning, but then with each incremental kind of iteration of the business, the product, ideally the unit economics should also be increasing, right? Network effects, right? This is true for, the most useful example is Facebook, but marketplaces, right? Marketplaces need to have network effects. Even my network, right? Angel network, the network effect is the more angels come onto our platform, the more it's valuable to more these startups, and the more startups we fund, the more it becomes valuable and legitimate to new angel investors, right? And there's a sort of a flywheel effect that kind of kicks in after a while. And I've seen that definitely in the last couple of months as we've really grown our investor base, and more companies are coming to us as well. Switching costs. This is quite important. You really want, once you've gotten a user locked in, you want them to stay with you, right? You want them to continue to be a recurring user. And so how do you kind of do that? How do you, maybe one is creating a service ecosystem. So it's not just one service, you're adding multiple services, right? Some of these platforms I've seen, particularly in the ride hailing space, the super apps are really pushing loyalty programs, for example, right? So then you could, the more you purchase, the more loyalty points you get, which allows you to purchase more. That kind of, once again, that sort of, virtuous cycle. And then brand and IP. This is very difficult. I've seen that being very difficult in the context of Bangladesh. Protecting IP is quite difficult. But then I'm so also surprised how many founders just don't do it, right? Thinking about your trademarks, copywriting your trademarks, thinking also about very little of the code that you generate, I would imagine, is kind of patentable, but certainly, think about how you can invest in protecting your IP, at least at the local level, and then whenever you kind of switch over to the holdco level as well. So I'll just use one example as a case study very quickly. So they're part of IC. They were the first company we invested in, called Jantric. So this is a problem that is in Bangladesh. I would imagine it's true for a lot of emerging Asia, is that the rate of vehicle ownership has exponentially increased. But what that also means is that as the rate of the whole market for services for vehicles has also exponentially increased, and in many cases much faster, because at least in Bangladesh, we have a very high, we don't manufacture vehicles, at least not yet, except motorcycles. We don't manufacture passenger cars. And then we have a very high VAT import tax on passenger cars. So what that means is most vehicles that people drive on the road, whether it's small businesses or whether it's individuals, are actually refurbished vehicles, often from Japan, right? And so they require a lot of servicing. But then if you're an individual vehicle owner, you're kind of screwed all the time, but two people. One is your driver, because there's a whole culture around having chauffeurs, and they're constantly looking for ways to complement their salary by skimming off the fuel money, skimming off the repair money. And then second is your mechanic, because they are fully aware that you're not fully sure what's wrong with your car. They often, add on services, just like, this happens in hospitals in the healthcare sector as well. But they add on services, they use faulty parts or used parts, and then they try to make sure that you keep coming back, right? So that was the particular problem that was faced by Shuvol, who is the founder of Jantric. Yeah, so just thinking about what kind of problem, it's a popular problem, right? Millions of vehicle owners in the country, both households and small businesses. It's growing, double digits, I think 20% per year. It's urgent. If your car needs fixed, to be fixed, it can't really wait. It is your primary, it's a big part of your family's kind of routine is to be driven. And you're not always, going to trust a random Uber driver with your children or your elderly parents, for example. It's expensive. Besides your house, it's probably the second most expensive asset for most middle-class Bangladeshis. And it would cost them tens of thousands of dollars not just upfront, but over time, mandatory, right? I mean, there's certain elements like, for example, registering the vehicle, getting insurance, which are also a huge hassle. They have to be renewed every year. I think, in Bangladesh, we have this archaic rule where you have to literally take it to the office, your vehicle, to be kind of inspected, and then you get your registration renewed every year. So Jantrik actually kind of does that for you, but beforehand you have to kind of do it yourself, right? That's one element of mandatory. But it's also your family. Like, you will hear from your wife if your vehicle's in the garage or in the shop, right? And if you're the family breadwinner. And then lastly, these are things that some problems related to your vehicle happens on a weekly basis. Say, for example, fuel. Some of them happens on a monthly basis and a quarterly basis. Right. And then also when you look at the unfair advantages, the founder, right? I don't know if she was in the room, but I found him to be one of the really top founders in Bangladesh. He's had a success of working in software development, started his own successful company, left all of that to kind of start Jantrik, which was quite unique. Another problem is, he faced this issue himself multiple times. And so that's why he decided to found the company. The product itself, what he's doing is he's creating a network of certified repair stations under the Jantrik brand around the city and around the country, around the city of Dhaka and around the country. And they all adhere to certain pricing guidelines. They all adhere to certain quality standards. They've got people on the back end kind of monitoring these services. They've got technicians that visit on a regular basis to make sure that these, inspecting these vehicles, as well as the stations, and as well as training the mechanics at these stations. And so, yeah, you're getting transparency, you're getting reliability, and you're getting standardization. That's important for many of these customers. And then acquisition, they've done a great job. Once people started hearing about it, it's been very much word of mouth. When it comes to monopoly powers, they've definitely thought about switching costs. So, for example, for the B2B sector clients, they work with some of the biggest corporates in Bangladesh. So what they've done, a lot of these corporates have multiple vehicle fleets. They also need repairs on a regular basis. They also get skimmed from their own people, but also from these garages. So Jantrik's created this fleet management solution where a corporate procurement person can then figure out, okay, well, this vehicle needs servicing at this time. When was the last time it was repaired? What was the actual repair? And then it only interfaces with one vendor, which is Jantrik. Quite difficult once they're locked in to be able to take them out, essentially. Brand is key. He's done a great job. If you could see by some of the design, I think a lot of people just know Jantrik and they automatically think about automotive services when I talk to them, which is interesting, at least amongst them, higher income strata of Dhaka. Network effects, right? So the more stations you have within your network, the more it's valuable to customers and vice versa. And they are working on some IP as well. So for example, with National University of Singapore, they're working on this app called Drive Safe, which it's mainly managed for fleet owned, whereby the drivers, for example, truck drivers can have an app kind of running in the background that kind of monitors their eye movements based on and figure out if they're drowsy or being too distracted and kind of warns them. So they're kind of deploying that in partnership with both NUS and the government of Bangladesh soon in the streets. So I'll just quickly go through the rest, to be honest. So pitching, I think you guys have, Ahmed Mirza did a great session. I would highly recommend if you weren't able to catch it, maybe spend some time with him. We work very closely together. But the two things I would just call out here, and this is his framework for pitching or pitch decks. Two things that, the key questions I always want to know from founders is, what's your vision, right? I get that you have a 12-month kind of timeline, but what exactly is your kind of vision to win the market in 3 to 5 years? That's important, right? And many people can't really, they're so focused on the short term, it's hard for them to answer. The second is, why now, right? There's so many things we could be doing. There's so many things you could be doing, right? And so what specifically are the enabling factors in the market that once again allows your solution or your startup to succeed and succeed quickly? So those are the two things I would just call out here. So once we get into the due diligence phase, in the data room, we're looking for kind of 3 different types of data, right? So business data, financial data, and obviously legal data or information. So business data, these are some of the things we want to look for. You may not have all of it, but yeah, we definitely want to kind of see some of access to how you manage customer information and data, CRM, vendors. Obviously, maybe interviewing existing funders, investors, some of the team members, your back end. Obviously, a very specific growth plan for the next 12 to 18 months, because that's how much you're raising for. But then obviously, we also want to see a 3 to 5 year kind of vision with some kind of a product roadmap, with the full understanding that it can change. But we want to know your assumptions. That's the key thing. We want to know how you think, and we want to know whether or not we can buy into that vision, right? Yes. And then in terms of financial data, definitely I'm always surprised by how messy cap tables are. You got, in these early stage startups, sometimes they claim that a cap table is one way, then you look at the actual cap table through the government registrations and the names are completely different. Don't do that. Try to fix that if you can. Totally understand that you may not have audited financials as an early stage company, 1 or 2 years of operations, but then definitely, you should be keeping financial statements. And what we're looking for is one, any kind of weird transactions, right? I mean, maybe it's money from the founder to to the company or vice versa, or to somebody that we don't necessarily recognize based on the cap table or legal documents. And then capital efficiency, right? How much have you truly accomplished with how much money you've actually put into the company? Those are two things that we look for when we look at financial statements. In Bangladesh, the banking sector is still nascent. A lot of transactions happen over cash. Mobile money is becoming a big thing. So we once again, if you don't have audited financials, we look to complement that through bank statements and mobile money statements. In terms of financial modeling, I mean, we have templates. I guess the main thing is we're looking for a forecast, right? At least for us, 12 to 18 months forecast with your main assumptions kind of outlined. And that's the most important thing. We want to know about your assumptions so we can kind of debate that. And once again, do we agree with it or not, right? Legal data, government filings, definitely, a lot of you may be in this kind of situation. It's certainly true for a lot of Bangladeshi companies is that they'll start locally, but then they'll re-domicile into Singapore. So, right, I mean, so we have to kind of look for that link, that official link in terms of share transfer. And co-shareholding between the Singapore entity and the local entity, and making sure that when we do invest either locally or through safe notes in the Singapore entity, that there is a link between those two entities, right? Otherwise, that's a kind of a red flag. Yeah, any kind of IP, copyright, trademark failings. I've seen this at least with Bangladesh is that a lot of teams don't have a CTO, they may not have a technical kind of co-founder, and so they may end up kind of outsourcing the beginnings, the first kind of iterations of the product to say a software firm, which is all right. But then if somebody else developed it for you, has the IP been actually assigned to the company, right? Otherwise, it doesn't quite make sense. That's kind of a big part of what we're paying for, right? Agreements, it's good to have these. Oftentimes they don't. And so what we do is then we sort of create an expectation that within 2 or 3 months of kind of investing that, we try to structure some of these relationships on a more formal basis between the company and its various stakeholders. We also obviously look at existing documents, any kind of key documents related to existing shareholdings. I guess in terms of structuring, this is the key question, right? You have to make a decision. Do you do a price round or do you do a not so price round? In Bangladesh, it's kind of determined upfront because if you're a Bangladeshi company, you don't have access to safe notes. You don't have access to convertible debt or convertible notes. And so you have to do a price round. And there's 2 ways to do that: common equity and convertible preference shares. And we do convertible preference shares. We don't attach any dividends or we don't attach any kind of interest rates or anything like that. It just simply means that, we have the right to convert 1-to-1 into common equity at certain points, but until then, we have certain rights on the investment, right, including a liquidation preference, anti-dilution, potentially, if it makes sense, if it's mutually agreed upon. And so, with common equity, you can't do that. You can't attach certain rights, and so we like to go with CPS. With a not price round, it's becomes much more interesting and nuanced because there's the basic idea is the valuation of the company will be determined by future investors, right, and therefore your shareholding will be then determined by future investors. Convertible debt is there, and then safe notes are obviously quite popular. And the 2 key kind of elements to that is obviously the valuation cap and the discount, right? So if the next round is higher than the valuation cap, then the investors will get it, capped at that valuation. And then obviously if the next round is lower than the valuation cap, then obviously the investors will get typically a 20-30% discount to that new valuation. So they're kind of, given the risk that they've taken up, they're able to get a premium compared to the next investors. Valuation, this is an interesting one. Let's say if you do a price round. At the angel stage, it's, I get a lot of these really fancy discounted cash flow models, and it's just not realistic because once again, in a year's time, the business model could be very different. It's very hard to extrapolate. Another element is looking at comparables and multiples. It's very hard. I found it very difficult in Bangladesh, at least, because we don't have enough history of transactions and transparency around transactions to be able to do comparables. Maybe it's less so in Southeast Asia, but I'm not sure. I'm sure it depends on country to country. I think another part is, taking kind of going to Crunchbase, taking kind of information that might be publicly available for, say your American or European counterparts or analog companies, and applying that to your business is not that useful unless your revenues come from those markets, right? So if you're kind of serving the local market, you're definitely going to have to pay a discount. And so that's also not so comparable or useful all the time. I guess, a few benchmarks and rules of thumb we use. Assume at an angel stage, you're going for 10 to 20% dilution. Any more than that, and you're setting up the company for failure because the angels own too much. And as future rounds happen and dilution happens, the founder would own less and less of the company, and therefore they would have a question around whether or not this is really their company, and being incentivized accordingly. That's one. And then there's levers you can pull, right? So for example, if it really depends as a founder, how desperate are you for that angel's money? How much you need it at that moment? And for angels as well, how desperate are you to get into the company? Maybe there's a lot of competition for that company. You really like it. It really fits within your wheelhouse, et cetera. And so that's one lever, right? It almost becomes like a negotiation. It is a negotiation. That's one. The second lever is obviously, say you're a SaaS-based business, you've got recurring revenues, or that's kind of going to be in your model. You've got pretty high margins. The cost of replication is pretty low. Relatively low, I guess, compared to maybe your marketplace model where you're taking a rake on the GMV. So it's the type of business that requires a tremendous amount of capital to scale, right? Particularly on the B2C side. And so you have to assume as an angel, you'll get a lot diluted quite fast and quite a lot over time. And so maybe for that kind of business, you might have to take more upfront if you're taking that first risk versus the former kind of business where maybe you take less or you're willing to take less, right? So there's different. There's also, I've seen certain founders who've worked at marquee names in the ecosystem being able to command much higher valuations and such. So there's a lot of different levers you can pull, I guess, on that kind of dilution piece. Last round is also important. Let's say you've already gotten some investment. That often becomes the benchmark for the next round. And then co-investors as well, right? The biggest check in the room determines kind of everything else, and you have to respect that. And so if somebody's taking 50% of the round and this is kind of their valuation, then you have to kind of respect that, right? And particularly if that co-investment happens or the last round happens in less than 6 months, it's very unlikely that a company would grow that much to command a much higher valuation. But that becomes an interesting kind of benchmark for when we come in. Key docs, these are, I won't go to details, but yeah, term sheets are quite important. That's kind of the beginning. What we do is we like to pool investors. We like to then ask, okay, who look at a company together, and we'd like to say, well, one, do we believe in the vision of the founder? Do we believe in the founder? Two, do we align on what this company needs to do to succeed, and where each of us can play a role in that? Three, how much are we going to put in based on how much the company is asking for, and how much are we looking for, right? And then what we do is we kind of create a sort of a group term sheet, and then there's a back and forth with the founder and the founding team, and that becomes the basis for everything. Once the term sheet's signed, and then we appoint legal advisors, financial advisors to the transaction. They do their own kind of due diligence. And once those reports kind of come in, then we then disperse the capital. But simultaneously, we're also doing these definitive agreements like share advance agreements. And once again, these are for common equity and a convertible preference, right? Otherwise, a safe note, you just have kind of a safe term sheet, right? Or a safe note agreement. And then post-investment, I'll just quickly touch on it. It's important, obviously, this is also a role we play as Bangladesh Angels, is that there's a lot of governance structure work that needs to happen, right, to professionalize the company. When it comes to maybe constituting boards, for example, we may take a board seat if we own at least 5% of the company, if not more. And then, I often sit as a board observer. And then there's a lot of things we also want to see around. There's also a lot of things we want to see around making sure that all of those things that came through in the financial due diligence, maybe your tax filings aren't up to date. I get it. You're a young company. Like, you're not thinking about those things. Maybe your government filings aren't up to date, but definitely do that, right? Post-investment and getting the habit of, I think, professionalizing, because everything you do up front helps you for future rounds, right? And future investors. Second is, just communications, right? All we're looking for, we're not looking for you to talk to us every day. We don't have time. But yeah, once a month, just send out an email. Talk about what's been the wins, what's been the struggles, what you're looking for as asks, right? Attach your kind of that month's kind of revenues and expenses, and then just kind of go from there. I think we're not looking for something too detailed, but most investors want some visibility. And I'm always surprised how much founders don't really invest enough in that, because it's that kind of stakeholder management is quite critical when you do need them for things, right? Whether it's, further investment, which has happened during COVID, you're looking for your existing investors to top up, whether it's, help with a certain kind of business prospect, whether it's a question, but, that sort of upfront communications is key. And then, the founders I've seen who manage their angels quite well are able to kind of create working groups with specific issues and problems, whether it's fundraising, whether it's a particular business development issue, a product issue. And they also, try to, curate their angels accordingly, right? So maybe, you try to bring in somebody who's an expert in finance, right? And somebody quite venerable, maybe an expert in marketing and consumer branding, for example, right? If you're a B2C startup, maybe you also look for people who are, product, really experts at product, working with, some of the large companies outside, in places like the US or what have you. You try to complement, you try to build these you try to build these different types of investors and bring them into the fold. And then, you use them for these different tasks. And I think that's, you just have to be proactive about it. And because otherwise, I mean, you could approach this as a purely transactional kind of relationship where people put in money and then you just kind of run things on your own, and that's perfectly fine. That's one way to do that. But from what I've seen, most angel investors, they want to be part of that story and they want to contribute. And so you're kind of missing a big opportunity if you're not trying to take the full advantage of it. Yep. So that's kind of it. I've kind of rushed through. I know that's been a lot of information as well. Happy to answer any questions that you guys might have, and also your feedback as well. What did you think of the presentation?
I think that, well, first of all, thank you so much for the presentation. And I think that's actually awesome that you gave us a little bit more time for Q&A, because the previous workshops were a bit jammed, and I think not everybody had the opportunity to ask the questions that they wanted. So everyone, this is your chance. If you want to ask a question, please raise your hand. You can do that if you go to participant. At the bottom, we have, I think, 3 buttons, and one of them is raise hand, or you can type it in the chat. So questions, opinions, feedback. Nope. Okay, go ahead.
Hi, thanks for the presentation. So my name is MJ, came from Seoul. I'm located in Seoul, Korea. So my company is doing some, my approach is to resolve the financial exclusion problem, both of developing country as well as developed country, because as always, some of excluded population is exist. So we call our company as a social venture. So my question is, you explained about some of your investors are some impact investor, you mentioned. So as the impact investments, investors' point of view, is there something special you wanted to look into very deeply or separately from the other ventures? So.
Yeah, it's a good question. So for us, I mean, we could. I'm curious what your thoughts are, because for us, I think the feasibility of the model is the most important thing, right? Before we necessarily specific numbers around impact. And once again, what I've also seen is that a lot of social ventures, what they do because they have access to it, is that from the beginning they'll try to raise grants, which makes sense, right? Because it's non-dilutive, et cetera. But then what I've seen, because I also come from the development sector actually. There's a reason I kind of left it. But what I've seen is that these kind of grants, because they also have that kind of pressure to scale, right? And scale quite rapidly. So what ends up happening is that, even if the model isn't necessarily right from a commercial viability standpoint, you're under pressure to, scale that model sooner rather than later to collect the impact numbers, right, from these particular stakeholders, right? And so that's, to me, like a big red flag, or it always makes me a little bit queasy, I guess, when a company has raised a ton of grant capital, but then hasn't really been able to find, it's almost like a catch-22, or maybe the other way is like, I don't know the specific word for it, maybe I'm forgetting it, but it's sometimes what I've seen is that being able to raise a lot of grants right away, particularly early in your cycle or your journey, is almost like a surefire way to never find actually true product market fit, because it's always distorted, right? So that's one kind of comment I would make on that for social ventures. The second is, there's a lot of, there's Shaper Impact Capital, there's the Nest, we work with these guys as well, specific like angel networks and early stage investment networks focused on impact ventures. And I think for them also, they would say the same thing. The first thing that they're looking for are commercial viability first and foremost. How are you thinking about that, and the sustainability of the business model, and then the sustainability of obviously your impact. And from as part of that, obviously, you can get very granular about it. I don't recommend it because you're trying to run a business, and to think simultaneously about impact data collection is quite difficult. It often ends up being a distraction, to be very frank, because you've only got so many team members, you've only got so much time, and so what I would recommend is, I think, just having a very high level kind of log frame. Once again, knowing that that may also change over time. Have an idea of the outcomes you're trying to generate, and have an idea within the customer journey of how you collect that, right? Through simple means, registration forms, surveys, etc. That very kind of high level, very kind of small surveys, to be able to, I think, be able to be confident about the impact you're generating as part of your overall story. I think that's important as well. And then the other thing I would also say, and this is something I didn't talk enough about in my presentation, is that going back to the market validation piece, and going back to the pain points. So, I would imagine you talked about working with people who are financially excluded. I'm always surprised by how little data founders have at the beginning when they pitch. And it just goes a long way if you're able to say, look, we interviewed 100 people, 100 households. We've interviewed 500 people, right? We've found, talking to them, that these are the pain points. These are the quantifications of those pain points. And that's kind of what we're trying to solve. I think that also goes a long way towards just storytelling, right? And this goes both for commercial investors, but also impact investors, to say, okay, well, is there a problem? Yeah, I mean, one would assume financial inclusion and financial exclusion is a problem, but how bad is it? How deep is it, right? And from your experience and with the particular kind of target customers that you're working with, those are things that I think it's important to kind of being able to weave into your story.
Thank you. I hope that answers your questions. The next one on the roster is Sharif.
Hi, thanks so much for the super comprehensive sharing. I love how you just went ahead like bullet speed and just covered everything in record time. So that's amazing. So I was in Bangladesh late last year to help a friend who runs an agriculture business potentially refinance their business in Singapore. And I noticed, there's a lot of like street food vendors there. So for myself and the startup Outpost, we're trying to modernize street food vendors. So that's the context of what we're trying to build. My question is two parts. One is, when you're raising for angels, we're just writing small checks of 10, 20, 25K. And then if it's pertaining to that data room piece, right? And then they want to, like ask about your bank statements, your accounts, your expenditures, yada, yada, yada. At what point is okay, given you're an early stage private company and you're not really sure how serious they are? And then at what point should we have a pushback on that? So that's the first part. The second part of the question is, so you mentioned the Bangladeshi startup. I forgot the name. I think it's Zentric, right? So they've got a operations company, and then they've got a holding company. So similarly for us, the market that we're launching first is in Indonesia. The holding company in Singapore. That's where all the investors and all the bank account is. And then we have an opco in Indonesia, a PT there, to open up the bank account and operational expenditures, right? So the challenge is sometimes, when we want to expand to other markets, when we develop a playbook, say for Indonesia, then we move to other markets like Malaysia or Bangladesh or whatever it is, how do we try and best incentivize our employees from an ESOP perspective? Like, do we have an ESOP in the holding co? Or then do we have a country or market specific ESOP within the opco that we then provide and invest to the local team there? What would be the most optimal way to do that?
Thanks a lot for those are two great questions. So I've actually faced this right? Recently, we put in about 100K into a company, and then other people were investing, so that the total round was like 250K, and then this was specifically asked by the founder, which is you're asking Series A questions at seed stage, and I think there's a lot of validity to that, right? And I agree. Sometimes angels can be way too, so one, I think in that particular case study, what happened was they had accepted some investments in the beginning of the company's journey, but there wasn't a good kind of paper trail or sufficient paper trail around that. And so it almost became an understanding that, we'll give you shares at a certain point in time, right? And these, I'm dealing with American angels, right? And so they're used to a different level of governance than Bangladesh-based angels, for example, right? And so, there had to be some understanding. I think what I would say to that is, it's a give and take, and it's interesting because Sadman's here, and we did a deal together as well. We were privileged enough to invest in his company, Dr. Koi / Rensoft. But he could tell you more, but it's a give and take, right? It's not going to happen right away. It's a relationship you're building. Very few of our investments take less than 90 days to close. And part of that's just relationships, right? It's relationship building because it's the first time through us that these angels are meeting these companies. And so it takes multiple kind of sessions, being able to visit their office, being able to, maybe the founders themselves being able to visit the angels, to be able to get a good kind of feel for whether or not, it is, people are coming at it in a genuine way, or they're just doing it because they like getting the data, or maybe they have some nefarious motives as well, right? And it's also it's also quite frankly the job of people like us, right, as facilitators, to be able to make sure that these questions that are being asked are legitimate and reasonable, and then also the angels that we're bringing are actually looking at these companies from genuinely, right, with the prospect to invest, with the obvious caveat that they may not, right? So I think that's one. And then the second piece, it's you mentioned bank statements. I don't necessarily know the context for Indonesia, for example. But for Bangladesh, I think a lot of companies just don't have audited financials in the early stages of their life cycle, right? And so, what these mobile money statements and what these bank statements end up kind of doing is they just complement the data, right? So we don't necessarily want to take it at face value. And even auditors, quite frankly, there's a whole corruption around audits, right? You can just pay somebody to just rubber stamp a particular audit piece, right? So it's just a way, I'm not going to look, I don't have the time, and neither do my to look through each and every line item, right? But it's just a means to figure out, okay, well, you mentioned that this money came in that month. Okay, let me just check, right? You mentioned that you got this investment in this part at this time last year. Let me just check that happened, right? So those are things that we're looking for. With regards to ESOP's a great question. So, and it's a very interesting, question you propose, right? Because one could theoretically do that. So you could have ESOPs at the holdco level, and you could have maybe ESOPs at the local co level, and then depending on maybe the functions that you're looking for. So whether it's somebody's a multi-country kind of executive or somebody's local, right? Theoretically, you could have those two levels. What I would say though, because ideally, and this is particularly probably for Series A investors and beyond, they like cap tables that are as simplified as possible, right? And oftentimes to simplify the cap table, they may even buy out existing shareholders, some certain shareholders, right? And so to then have a very convoluted structure where then you have an ESOP at the local, international level, and at the different local levels, that may be a little bit of a, it may be a little bit difficult, because unless it's unified, right, you may have 20% of the ESOP in say Indonesia, but then 15% in Bangladesh. By the way, it's actually not that easy to create ESOPs in Bangladesh or pocket shares in Bangladesh, but it just really makes it convoluted. From a governance and cap table perspective, like I guess what we call globally fully diluted basis. So I wouldn't necessarily recommend it unless you absolutely. I think ESOPs are a great idea. I think generally, I didn't talk about that, but we also like to see that at least 10-15% ideally is kind of set aside for ESOPs at each round, maybe on a pre-money basis. That hurts the founders, that helps the new investors, but then for all okay, maybe we'll take it on a post-money basis. Yeah. So those are, I guess those were your two questions.
Yeah.
Yep.
So if let's say if you have one single holding ESOP, and then after that, how do you figure out alignment of incentive for people? Because some folks will just work only in a local market, and then they won't contribute on a holding co level, and then some would. So,
yeah, it's a great question, and to be very frank, I don't think I'm the person necessarily to answer it, because I've yet to have a company that works in multiple jurisdictions, and we've yet to implement ESOPs across multiple jurisdictions. Imagine, I guess, at a test level, you would, even within the ESOP, you would have a certain level set aside for local employees versus, and then it would be a lot less compared to maybe what you would set aside for international employees, right? And international employees who have that capacity and the skill sets to go across multiple countries is quite rare, right? It's not that, they're pretty expensive. You have to do that anyways. Yep.
Okay, fair enough. Thanks. Thank you so much.
Awesome. Next is Lynn, and after that is Sadman.
We're doing our seed round right now. I'm wondering, and we're looking to do a bridge while we close up or get our seed round done. Are safes common with during a bridge, for a bridge?
Absolutely. I mean, safes are essentially bridges, aren't they? Right? They kind of serve as the bridge to the next round, and with the understanding. And I mean, I would, you know, within any kind of, I mean, Y Combinator safe, there is kind of, at least the ones that I've worked with, and we work very closely with Accelerating Asia. We've invested in a couple companies together with regards to safe timetable, right? So that unless there is a round kind of raised within a certain period of time, it will automatically convert at the valuation cap that was proposed, right? So I think, you know, safes are a great way to be to be able to raise bridge capital, particularly because you just don't have the time or the inclination to spend multiple months potentially going out and finding investors, negotiating valuations, coordinating everything, et cetera. So just having a simple safe, I think, is quite good. Absolutely.
So what happens if our seed round is not priced and is through a safe too, and then this bridge we're doing has a certain valuation cap, and then the first price rounders are like future Series A.
Yeah.
With Series A's investors,
yeah.
They think that this valuation cap with our bridge round would they think it's too low? Possible?
I mean, I think it's also dependent, right? So, you know, at least from the way our angels think, is that whenever they take a valuation cap, they're kind of looking at also, I mean, it's one thing to note is it's not the valuation at that, I mean, we have to make sure that's clear. But on the other side, it kind of is, right? You're kind of valuing the company in some ways, and you're putting a cap on it or a floor on it, right? And so what might end up happening, for example, is that you know, we've done this with one company recently where we've said basically, you know, we're putting in money right now. It's essentially a pre-seed round. You're going to probably try to raise a seed / in the next 12 months. So in that period, you know, we'll kind of we'll give you this valuation cap, and then within a 6 to 12 month period, somebody else comes in and they want to come in at a lower cap. We have the right to convert our safe to that lower cap, right? Until that round happens, right? So that I've seen that happen, and right now it's kind of a buyer's market, right? It's an investor's market, to be very frank. So investors can demand those things that maybe they otherwise would not be able to, say, pre-COVID, for example. And maybe we'll get to that stage of, you know, being much more founder-friendly in the future. So that's one thing I've seen. What I would imagine is, and I think that's perfectly valid to do safes within, say, within a pre-seed and a seed. But then I would imagine the expectations for both existing safe investors, definitely for existing safe investors, is if you were to take, you know, seed stage safes, then that valuation cap would represent that premium, right? Compared to what they're coming in at, right? That would be their expectation. And if it's not, then obviously it's almost becoming like a flat round or a down round. And there's some questions around whether or not the business is showing particular traction. But I would imagine that would be the expectations of your, you know, investors at that particular point in time, is that within the 6 to 12 month period, if whatever you do, whether it's a price round or whatever it's another safe round, be at the same valuation cap, right? That you're actually able to increase that value.
Okay, because people are already waiting for the next session here. So one last question, Sedman, shoot.
Thank you, Martha. So, Nirjhor, I have a question for you. You have a long experience of working with early stage startups, and as long as I know you, I have seen you investing like last 5 years of your career with the, like, you know, early stage startups, and you know, we're kind of growing and stuff. So you have a lot of experience working with the angel investment. So this one question that always kicks into my mind, and I feel like this is the right platform so that everyone can actually get an answer to that. Is it possible for a company to be solely dependent on the angel investing and actually get that growth, or, you know, in the long term, like, you know, get that sustainable growth that you would see in a venture-backed company, right? So do you see that happening, or do you have an example where, like, you know, actually angel investment built a whole company that is super profitable and actually getting a lot of traction? So what's your take on that?
It's a great question, right? So I think, you know, it has to be colored by the fact that in Bangladesh, at least, and you know this too, where there's a lot more angel investments, but then because the value chain isn't yet developed, you don't have enough seed and Series A institutional capital, right? So what ends up happening often is that companies almost get stuck at this stage where they continually angels, maybe at a slightly higher valuation to the last group of angels, and they continually come in, right? So that's a challenge for the overall ecosystem. And I don't know if this is the challenge that you guys have in your other markets, but definitely that's a challenge we have locally within Bangladesh. Having said that, what are elements or what are examples of angel investors really being able to take a company to the next level? A company that we work very closely with, or we know very closely, Sheba, right? It's the largest smart services marketplace in the country. He literally created the angel investor market because he got like 30 angels to back him at the beginning, and then he's been able to provide them with exits. But what's been interesting is that they recently raised a couple of times. They've been able to raise money from local conglomerates, which I would imagine for many of you is also a feasible option. But that came through their angel investors, right? Those introductions happened by way of their angel investors, right? So that's, and so the same thing happened with the largest ride-hailing platform in Bangladesh. One of their angel investors had a really good close connection with an angel investor in Gojek,